Yo, what's up you guys? Welcome back to a new video, and in today's video we're going to be covering high CPI, what the SVB bank is, why it's collapsing and how it's going to impact the stock market, and the interest rate decision that is potentially laying ahead for the dollar, but also how it could potentially impact the market there as well. If you're new to the channel, a sub would be appreciated as I provide valuable educational content on a daily basis. And if you do enjoy the content, please do consider smashing that subscribe button there as well. Now, without any further ado, yesterday we had the CPI data came through. Today, Wednesday, we got core CPI, but we're going to focus on the CPI M/M, which means month over month, and YY means year over year, in case you didn't know. But the CPI reading obviously came through higher than anticipated, which is quite funny because if you look at the technical analysis, every time the dollar hits a certain structural level, the market tends to come out with positive news or good news to drive the prices of the dollar index. But the Feds are now stuck between a pillar and a pole to decide whether or not they should hike interest rates or not. And we're going to get to that point very shortly. Article from CNBC reads, inflation gauge increase 0.4% in Feb as expected and up 6% from a year ago. The consumer price index went up 0.4% in February and 6% from a year ago, which is year over year. Then 0.4% shows us it's month over month, in line with the market expectations. That says here, a drop in energy prices helped keep inflation in check while shelter cost increased. Now the probability that the Fed would raise the benchmark interest rates a 0.25 percentage point next week increased following the report. Now the Feds are due to make a decision on the interest rate next week coming, and there is a basically, the thing is, think about it in this way, right? Whole month you're talking about when you get your salary, you are going to put a turbo on your car. Whole month you're like turbo, and then just before you get paid, then your gearbox gave in, or your gearbox gives in. Now all of that changes now, so now you can't go turbo, now you must go gear. Now you have to fix something else. So what I mean by that is that the whole expectation, based off what Powell said on Tuesday, was directed at what the CPI data shows, right? He said that if the CPI data comes out higher than expected, not directly, then the Feds are forced to increase interest rates. Then the job report comes out, which shows that people are losing their jobs, meaning that the Feds are making progress with bringing inflation down. Then the actual inflation report come out and says, but there's not as, there's not much progress as possible. Then the Fed says, okay, but now we can't hike interest rates because we've got a bank that is negatively impacted by interest rates. So what do? Now, I don't know what the Feds are going to do next week in terms of interest rates. So I'm not going to tell you I knew it's a buy or I know it's a sell. But what I can tell you is the Feds are now stuck between, do we hike interest rates to save the dollar, or do we not hike interest rates to save Silicon Valley Bank? So that's for the Feds to decide. I don't know. I'm here to give you probability, the highest probability based off information that I have collected. Now, the question is, what is SVB Bank or the Silicon Valley Bank? Why is it collapsing? What does it mean for the market? Now, I could go and explain everything to you in layman's terms, but I'm going to take you through an article that explains it, and then I will obviously give my own readings in between as well, just to simplify the information there as well. Now, we know a higher CPI reading before we get here. We know a higher CPI reading means higher interest rate hikes, right? We should know that, but we can't just expect that because now we've got a bank that's in trouble, that we've got Powell, we've got the Federal Reserve going like, yeah, we understand the bank has got a problem, but it's directly aimed at the tech sector. The Silicon Bank is big for lending money to tech companies. So that's not much to do with the index. The problem with one of the reasons why the bank also collapsed was because of higher interest rates. Tech companies are unable to pay back any money they might have loaned in pandemic, But now the Fed are stuck between hiking interest rates because of low inflation, because of high inflation, because they need to bring down inflation. But now they got a bank that needs saving here as well. But let's go and read through this article very quickly. The first thing is, what is the Silicon Valley Bank? They came out in 1983, just before collapsing. It provided banking service to nearly half of all US venture-backed technology and life science companies. Now, here you can see, technology companies. So if you look at the Nasdaq 100, is a composite that is made up of 100 of the top tech companies around the globe. So these guys were big. And one of the reasons, and that's why you saw the stock market took a tumble because of them. But the stock market took a tumble as a result also of the fact that the bank is suffering due to interest rates that's being increased, putting pressure on these companies, so they are not able to service their debt with the bank. So the bank is losing. Apart from that, they've also invested many bonds in 2020 during the pandemic, and way before that when interest rates were still low. So higher interest rates are also coming for them. So they're getting companies that's not paying them back. They're getting bonds, the interest rate hurting bond prices. So they're losing. And now people are coming like, we need our money right now because we need to. Now, all of that basically brought the bank to where it is at its knees. Now, let's continue over here. It says the bank assets, which include loans, more than tripled from 71 billion at the end of 2019 to 220 billion, like 2022. 220 billion at the end of March of 2022. Now, you can see that happened throughout the pandemic period, because why? That's when the pandemic was in, and they went from 71 billion, in loans up to 220 million, because during the pandemic period, obviously a lot of people were at home, and that made space for a lot of companies to come in and service people while they were sitting at home. It says here, according to the financial statements, deposits ballooned from 62 billion to 198 billion over that period, as 1,000 tech startups parked their cash at the lender. Its global headcount more than double. Now, why did it collapse? Now, the bank collapse came suddenly from a frenetic 48-hour during which customers yanked. Yanking basically means where customers came and was like, we need our money right now. Everyone was like, I'm going to get that money. Deposits from the lender in a classic run on the bank. But it says here the root of its demos go back several years, like many other banks. SVB plowed billions into US government bonds, like I said, during the era of near zero interest rates. If this needs to make sense to you, think of it when COVID struck in March, right? If everyone was like, we're going to reduce interest rates, get people to get into debt more, right? At the moment, the same people who took out a bond in 2020 are probably now paying twice, not twice, but about half the price in terms of what they were paying. So we have a similar situation here. People are being put under pressure because of the increase in interest rates. They are putting it under pressure because as the interest rates increased, bond prices had decreased. Now it says here, when interest rates rise, bond prices fall. So the jump in rates eroded the value of SVB's bond portfolio. The portfolio was yielding between 1.79% last week, far below the 10-year Treasury yield, around of 3.9%. The yield means a return on your investment. Now, they say what sparked the bank run. While SVB problems can be tracked to its earlier investment decision, the run on the bank was triggered Wednesday when the lender announced it had sold a bunch of securities at a loss and would sell 2.25 billion in new shares to plug the hole in its finances. Now, you see what happens is there's a good saying. You can go and read the entire article. But there's a good saying, everything that you do in the dark will eventually come out in the light, right? So they've been suffering. They've not been saying anything. And then now you get to a point where things become so difficult for you, where you have to go and open up. You have to go and speak about it. So just when they thought, okay, maybe people is going to expect us to, But the thing now is that the Feds is the only people that will give us an indication of where the market's going to go. But because of this negative, because of the massive corrections that have taken place in the market, or impulses on certain pairs, there's now room for a correction for us to get into the market. We're going to start with the dollar index. Now, the dollar index is trading at bullish structure at the moment. If you go on the monthly, you'll see here market broke above very strong resistance, back to test it. But we're not here to look at monthly candles because we are retail traders. Now, what we have here on the daily time frame is we've got this massive impulse, soft and impulse. You expect a correction. We also have a market that broke above resistance, tested it as support, broke below support. All of that supports once again turned resistance. So obviously expect a correction before we could potentially see a continuation to the upside. We have this massive impulse, soft and impulse. You expect a correction, and the best way to measure that correction is by taking your Fibonacci from the high to the low of this massive impulse. And we can see we've got a 38.2 that's lining up perfectly with this previous level of support that got broken, that is now turned resistance. Now, I'm not going to tell you what's going to happen after that. I'm only going to tell you what is going to happen for now, and then once the market gets there, we can then start looking at alternative options in terms of which way it is that we do want it to go. Now, the next thing that we got over here is we've got gold. Gold that obviously printed this overextended W formation. After an overextended W formation, you expect a pullback to the left leg. The market printed a massive impulse. So again, after an impulse, you expect a correction. And if you take your Fibonacci from the low to the high, we can see over here that we do have the neckline of the W also here, giving us a 50% pullback. Now, it is known in the market that every time the market prints a massive impulse, right, you always expect a 50% pullback, which is exactly what we could potentially see on gold, because gold has been massively extended to the upside there also. So I do expect a deeper pullback with gold. However, I don't expect the market to just go right through this level over here. It's very important that you are careful because we are faced with this structural level that the market had created. I do expect gold to retrace there at least, and then from there, if and only if we do get a break below this level, then by all means we can look for that continuation to the downside. Next up, we've got the Nasdaq. The Nasdaq yesterday, like I said to everyone in that Telegram group, the market was at that price, anticipated that move. Still some more continuation to the upside for the Nasdaq, and then from there we can obviously start assessing the price action based off the interest rate decision that the Feds have. We also have a structural level over here that the market had printed and just reads. I do expect a slightly continuation to the upside for the market to go and continue to fill in the price to the wick somewhere around that level over there. There we go. Next up, we've got the Dow Jones. The Dow Jones also, just looking at this, we do have a correction for the Dow Jones. Let's do this. Let's do that. There we go. So this correction is obviously expected. The market printed support, broke below supports, back to turn as resistance. We have a massive impulse. After an impulse, you expect a correction. If you take your Fibonacci from the low to the high, once again, we've got a 50% confluence that's lining up perfectly with a previous level of support that is broken, that is now acting as a level of resistance. Next up, we've got Euro USD, broken above this very important level of resistance. And once resistance gets broken, it then acts as a level of support. Now, we do expect a pullback on Euro USD as well. And then again, from there, monitor price action once again, and then make a further trading decision. Guys, that is it from my side. Hope you enjoyed the video. The signals and mentorship will be back on the website over the weekend. Thank you for your time. And as always, cheers for years.